90s had the dot-com mania. The mid-2000s had real estate. Both ended the same way, with real crashes, real damage, and years of "I told you so" from those who stood by and watched. So now, in 2025, everyone thinks they've already seen this movie. AI is the new villain. Nvidia is the new Cisco. And every time stocks hit new highs, someone screams bubble and predicts a crash. But Tom Lee of Fundstrat doesn't see a speculative bubble forming. He sees the early stages of a structural change where productivity, profits, and liquidity are all growing faster than the market can price. Instead of hype driving valuations, it's the fundamentals catching up to a new reality. According to Tom, this is not a replay of the internet boom or the real estate frenzy. It's the beginning of something very different, a multi-asset super cycle driven by innovation, monetary expansion, and a complete reevaluation of what growth is worth in the AI era. In this video, we analyze 4 of his most important insights: why the AI bubble narrative doesn't hold up, how stablecoins could quietly be driving the gold rally, why Ethereum is entering its own 1971 style transformation, and why this bull market is still the most misunderstood rally of the last few decades. But before we continue, just a quick reminder that only a small percentage of you watching are actually subscribed to the channel. If you're getting value from these videos, click that subscribe button. It's free. It supports the channel, and you can always change your mind later. Let's get back to the video. People see Nvidia and immediately think of Cisco. They remember the charts going vertical in the 90s and assume it must end the same way. But this time, the fundamentals tell a different story. Corporate earnings are rising, costs are falling, and productivity is breaking records. The AI bubble crowd is comparing the emotion of 1999 with the execution of 2025, and they're overlooking how distant those two worlds are. If we're measuring bubbles based on the risk/reward ratio, we're quite far from one, because in 1998, in September, which is similar to today, because the Fed was on pause and then started cutting again. In September 98, Cisco, which was the biggest company at the time, was trading at 56 times earnings. 18 months later, it reached 210 times. Now, Cisco produced a commodity router that had many competitors. Nvidia today is the most scarce and unique company in AI. It produces a chip that anyone building a top-tier model needs. It trades at 27 times forward earnings. Costco trades at 50 times earnings, and Walmart at 34 times. So Nvidia is still cheaper than a warehouse club company. So I'd say that's why we are quite far from a bubble. And when you point this out to people who are skeptical or critical of AI companies, what is their response? I think people then say, well, there's a generalized problem. Stocks are expensive. And, because I was just in Latin America, and that's what many pension clients said. But for me, the problem people have is that stocks are trying to discount the future, and AI is not just a labor replacement. So we can calculate, the replacement of jobs, and that's one use case. But then there's this agentic and super intelligence potential that creates productivity. So, how do we discount that in today's stock prices? Actually, I think stocks are still cheap, and I know Jensen Huang, CEO of Nvidia, was in New York recently. He met with some analysts, and I think many of the key takeaways people got is that in the AI world, the companies, the businesses that are spending are starting to see a return on AI spending, which means spending is increasing. Actually, I think AI spending is actually accelerating. Well, it always seems funny to me how people yell bubble. But the more people yell bubble, the more unlikely it seems that we are in one. Yes. And then how do you have a bubble when every time you hear a CEO of an AI company open his mouth, he says, we can't keep up with demand, right? And then, on top of that, the earnings reports come out, and there are companies with market caps over $1 trillion saying, we are growing faster than we thought we would grow. We are driving more profitability with fewer employees, which means they're becoming more efficient, more productive. So they should be worth more, right? Yes. And you make a key point, because I've lived through 3 bubbles in my 3 decades of research. The biotech bubble was the most recent. The one before that was the real estate bubble, and the one before that was the internet bubble. And 3 for 3. Not only did people deny the bubble's existence because they could justify it, but we saw behaviors indicative of a bubble. In the biotech bubble, healthcare hedge funds were funding university projects to get an edge on the molecule. I mean, if that wasn't bubble behavior. And as you know, in real estate, people were doing crazy, absurd things. This is not happening in AI. Actually, everyone is so measured in today's AI that it doesn't feel like a bubble. When Tom analyzes the numbers, the contrast is striking. Cisco at 210 times earnings versus Nvidia at 27 times. That's not speculative mania. It's compression awaiting a re-rating. And after that clip, you can feel the perspective shift. Nvidia isn't a maybe story. It's a margin machine. AI isn't destroying value. It's rebuilding efficiency from the inside out. For the first time in decades, companies are growing faster with fewer people and bigger profits. The irony? Everyone's talking about a bubble during one of the most disciplined investment booms in history. There's no frenzy, just disbelief. The gold rally has confused almost everyone. Central banks haven't changed course. Retail demand hasn't exploded, yet prices keep climbing. So, where is the demand coming from? Tom believes it's not from the usual suspects. It's from crypto itself. Gold moves first, and then Bitcoin catches up. So I think there will be. Gold's network value just increased a lot. And so let's say gold stabilizes at $5,000. That would put Bitcoin's fair value, you know, between $1.60 and $2 million if it matched gold's network value. So I think it's actually helping Bitcoin's future terminal price. So you think if gold stabilizes at $5,000, Bitcoin, you take the market cap of gold divided by the number of Bitcoins, then you get $1.60 to $2 million per coin. In what time frame can we get there? Well, I mean, I can see it in 5 years for Bitcoin. So I think 5 years. Yes, yes, I think Bitcoin. Yes, I think Bitcoin is not limited by gold. It's actually being pulled up by gold. And because the money supply is growing, right? Um hum. And then this year, gold is up about 60%. Bitcoin is up 18 to 20% depending on the day. Do you think on December 31st, 2025, looking back, Bitcoin will have outperformed gold in 2025, even though the latter has such a big lead now? Yes, I mean, we have a lot of time. We have. We have 10 weeks. And as you know, Bitcoin makes its moves in 10 days a year. So, Bitcoin's best days are in the fourth quarter? Probably yes, because we have catalysts, Fed easing. We have a shutdown that was risk off. We have China US tensions that, whenever news about China comes out, Bitcoin takes a hard hit, right? Because it's money flows and deleveraging. So that goes away. We have seasonality that favors stocks going up. Stocks going up helps Bitcoin. So for me, the odds of Bitcoin having a huge fourth quarter are very high, and not all of these would be tailwinds for gold. So, I wouldn't rule out. I still think it's possible for Bitcoin to reach $200,000 by the end of the year, once he lays it out. Stablecoin issuers are quietly accumulating gold as collateral. The puzzle pieces fit. Every new tokenized dollar adds organic demand to the metal backing it. Liquidity circulates between the analog and digital worlds. This has huge implications for Bitcoin. If gold's network value rises, Bitcoin's ceiling rises with it. Gold at $5,000 doesn't just reward gold bucks. It rewrites Bitcoin's fair value to over $1.6 million. Tom's point isn't a price target, it's a mechanism. The more money the world digitizes, the stronger both hard assets become. Gold and Bitcoin are no longer rivals by ideology. They are partners in liquidity. If Bitcoin is sound money, Ethereum could be the solid infrastructure. Tom sees its trajectory mirroring Wall Street's reinvention after 1971, when the US abandoned the gold standard and financial engineers built the modern system around a synthetic dollar. We're watching the same script play out, this time on chain. But Ethereum, which we've written about, is probably in a super cycle similar to what happened to Wall Street in 1971, because in 1971, the United States withdrew from the gold standard. So the dollar effectively became synthetic, completely synthetic. So Wall Street stepped in to make sure the dollar remained the reserve currency. So they built futures, CDs, money markets. And it was successful because within 10 years, even though the dollar was only 27% of GDP, it became 53% of central bank reserves and 80% of all financial market quotations. So the yen didn't win. The German mark didn't win, or the French franc. In 2025, we are tokenizing more than just the dollar. The stablecoin is the successful product, which is a tokenized dollar. But as you know, Larry Fink, BlackRock, Robinhood want to tokenize everything on the blockchain, and they will build it on a neutral public chain, which is currently 70% Ethereum. So, Ethereum is experiencing the same 1971 moment when Wall Street was rebuilding everything on a blockchain, which we think will be Ethereum. Ethereum could recover its Bitcoin slash Ethereum ratios from the 2021 highs. That would bring Ethereum to about $21,000 per token. So, it's I think, an undervalued asset. And by acquiring more and staking it, we benefit from the power law. And so far, it has been successful. Bitmine, likely a reference to a mining company, is the 30th most traded stock in America today, with $2.1 billion in daily volume. And, it benefits from I think from our clear communication. We publish a monthly president's message explaining our thesis on why Ethereum is in a super cycle and why Bitline, likely a reference to a company, continues to acquire and stake its Ethereum. Now, I'll play devil's advocate for you because many people will hear this, and those who like Ethereum will say, he's a genius. I agree with everything he said. Why do you only say $21,000? It will go to $100,000, right? Or whatever other crazy number. I think people who don't like Ethereum fall into two categories. There are Bitcoiners who don't like anything beyond Bitcoin. And then there will be those from, like Solana or Avalanche or anyone else, who, believe in this smart contract thing. But it's just that I have a different favorite horse, right? To the Bitcoiners who say all altcoins have no value. How do you argue with them about why they're wrong? I myself am a Bitcoiner. I think Bitcoin, and we explained this in our presentation, is digital gold. So it stores value, and transfers value exceptionally well. Bitcoin is sound money. I believe that. But Wall Street will build products and tokenize products. They won't build them on the Bitcoin blockchain, you know, because they need a smart contract platform. And as you know, if you look at Solana or Ethereum, if you look at the total value locked TDL, about a third of that value, the gross value, becomes the intrinsic value of the chain. It has been the floor for Solana and Ethereum. The global economy is $80 trillion, but it's understated because, GDP is a final sales concept.